In this class, we continue our discussion on microeconomics. In another class, we discussed about the demand or the demand curve, and in this class, we start with the supply curve. A supply curve shows how many units producers would be willing to offer for sale at different prices over a given period of time. So here, in the supply curve, our analysis focus on the producers, not an individual consumer. And for producers or a firm producing goods or services, what the price they would like to sell, and if the price is set, how many units they offer for sale in the market, given a period of time. And the supply curve of a firm is underpinned by the desire to make profit. In other words, the supply curve itself, the quantity supplied by the firm, can help the firm or the organization to make profit. So it doesn't say the sale will make loss. We assume that the price on the supply curve can help the firm to make profit. It shows what a firm will provide to the market at certain prices. Here is the supply curve. At the same rationale, the supply curve is lying on a chart showing the price, the relationship between the price, the P, and the quantity, the Q. Given that the price is at P1, and along the supply curve, at this price, the firm will produce at Q1. If the price is going up from P1 to P2, then the quantity supplied by the firm will increase from Q1 to Q2 here. It is the rationale of a basic supply curve on the chart. So here, it explains in more details. If the prices that goods can be sold increases, then each unit will make more profit for the supplier. Say from P1 to P2, then it means the manufacturer or the firm would like to produce more to the markets. So in general, the supply curves tend to upward sloping. So you can see the slope or the curve is on an upward sloping instead of downward sloping like the demand curve. And next, we talk about conditions of supply. If the price is the same or we keep the price constant, we need to see what other factors affecting the supply curve to move. So given the price no change, then the company or the firm may produce more because the other factors changed. Here are two ways of changes. First, the downward shift. It means the supply curve shift from S1 to S2 is the downward shift, and another shift is the upward shift. So let's see. Let's start to discuss about the downward shift first. The downward shift of the supply curve here, showing that an increase in supply at the same price here, the same price, but the quantity supplied is increased from Q1 to Q2 here because of the supply curve shift from S1 to S2. It can be explained by the lower of costs of production. It means that the firm can produce more goods given the same prices because it has more profits and due to the lower cost of production. And next, the upward shift. The upward shift of supply curves means that the cost of supply has increased. At the current price point, less will be supplied now. As shown here in the graph, the price no change because of the shift in the supply curve. What we call the upward shift, the quantity supplied will be lowered from Q1 to Q2 here. It assumes that the supply curve is inelastic here, the elastic supply curve. And there are factors or the conditions of supply showing why there's an upward shift or downward shift. The two factors under upward shift of supply, including higher production costs and indirect taxes. For higher production cost, it means that the cost of production may increase. Say the factor of production, no matter it's labor or rents, are more expensive. And the conditions of higher costs, like wages, for the goods produced, and the overall wage cost per unit increased. Because of the higher input prices, it leads to the reductions in supply. Another factor here is indirect taxes. For indirect taxes, like VAT, the value-added taxes, makes supply at existing prices less profitable. With an indirect tax, the costs of production are raised directly because the tax must be paid on each item sold. And for each product or for each product sold, the profit margin is reduced. So here, if there is an indirect taxes or increase in indirect taxes, the quantity supplied will be lower because of this upward shift of the supply curve. And the factors affecting the supply curve to shift downward or increase the quantity supplied at a given price level, including technological innovations, efficient use of existing factors of production, lower input prices, and reduction of abolition of indirect tax. For technological innovations, for example, the improvement in the technology for microchip, it helps to lower the cost of computers and led to large increases in supply. So it's one of the technological advances that helps to lower the production costs and increase the supply of goods. And efficient use of existing factors of production. That means we have the labor, we have, say, the rents on the given land, and an introduction of a shift system for working may help to improve the overall productivity of the labor force. Then it used the same labor hours, but it can produce more goods for sale. Then it improves the overall supply condition. And lower input prices is quite straightforward because, like the factor of production, say wages or land costs, if the cheaper material price or lower labor costs can help to improve the overall volume in the supply, because just the price lower, the manufacturer is happy to produce at the same to sell at the same price with higher profit margin. And for reduction of indirect tax, as mentioned, on the upward shift of supply, indirect taxes is a barrier for manufacturer to produce more goods because of the VAT, for example. and reduction of the indirect tax helps to improve the profit margin for the firm. Then it helps to improve the quantity supplied by the firm. Now, we would like to put the demand curve and the supply curve together into one chart to show you what the impact. And in the analysis, by putting demand and supply together, the first concept that I would like to share with you is equilibrium. So what does equilibrium means? It means that if the demand of consumers and the supply plans of sellers correspond, then the market is deemed to be in equilibrium. So in terms of the chart, it shows the demand curve and also the supply curve. We put this demand and supply curve all together into one chart, showing what's the individual consumer's demand for a particular product at the price, say at price P. The quantity demanded is at quantity Q, and at this price point, for the supplier, they are willing to supply at quantity Q as well. So that means both sellers and buyers realized in the situations that equilibrium meets both demand and supply at the same point, same price point, and same quantity demand or quantity supply point. Thus Q, the quantity, is the equilibrium quantity, and P is the equilibrium price in this market. At prices and outputs other than the equilibrium, that is the P and Q, either demand and or supply, aspirations could be fulfilled but not both simultaneously. That means maybe at a particular price point, the demand of a particular consumer is satisfied, but for the supplier or for the seller, they are not happy about this price, so they are not willing to offer enough or adequate quantity of goods in the market. So let's explain a bit more in the following. Here is the chart showing how the not equilibrium situations occur. First, we see price 1 or P1 first, the price 1. It is the price above the equilibrium price at P. So it is a higher price, and given a higher price, according to the demand and supply curve, they are not at the equilibrium point. That is here, the equilibrium point. At P1, the higher price, consumers only want Q1. The consumers only demand for the goods at quantity level at Q1. But producers, because of higher price, they are willing to produce more for the market. So here, the supplier is happy to produce up to Q2. So you can see that at price or P1, the demand is only at Q1, and for supplier is happy to produce up to Q2. There is a situation called surplus or excess supply here, because the suppliers are happy to produce up to Q2, but the consumers only demand up to Q1. They are overstocked in the market, which is called excess supply. And at the price of P2, that is the price lower from P to P2, in this case or in this scenario, the consumers, they demand more of the goods produced because it's cheaper. They can afford to buy it, and they're happy to buy more. So in these situations, the quantity demanded right now is at Q2 when the price dropped from P to P2. However, the supplier or the firm, they produce the goods and supply to the market. They found the profit margin is lowered, so they are not willing to supply as much as possible or the items demanded by the market or in the market. So they are just willing to produce up to Q3 here. And then in the market, the consumers would like to buy more, but the suppliers cannot produce as much as possible to fulfill all the consumers' demand. Then there is called excess demand here, or shortage. In this case, no matter there's excess supply or excess demand, the demand and supply, they are not at the equilibrium, so it causes a bit complicated in the market. When there is surplus or excess supply, say when the price is going up, like in P1, the situation is there are many items or goods produced by the supplier and flow in the market. So in this situation, there are misallocation of resources, because the supplier should shift of their production to other items that can produce to fulfill in the market. They're just waste of the resources to produce a lot of goods that just keep in the stock or in the warehouse. In the economy as a whole, it's not a good indicator because there's an excess supply or shortage or surplus. On the other hand, if the situation like in P2, the price is so low, the consumers demand as much as possible, but the suppliers cannot fulfill all the demands. It is another situation that the people may have to line up for the shortage of goods. You can see a lot of people lining up or waiting for the goods to be sold in the shop. It is the waste of the time for those consumers. Apart from what I mentioned about surplus and shortages, there's a possibility the situations of the equilibrium situations will be changed. For example, initially the situation is at P, but one day there's a change in the consumer demand. For some reason, like the taste change, the new demand curve right now is shifted from D to say to this new line called D1. Then the new equilibrium price will be changed to here. But given that the market, they don't know, or the supplier, they still charge at price P. They don't adopt the new change in the shift in demand curve. So there's a gap here. I call it, say, X. This gap is the excess supply because the supplier still produce the good, and they expect the quantity demand by the market is at Q instead of new demand or the quantity demand. So they are set the price at initial point, they don't change it, but the shift in demand from D to D1 affects the overall situations. Okay, so here the demand or the quantity demand will be less or much less than Q. It's close to Q1 here maybe. And in these situations, it's affected by the change of the taste or preferences by the consumers. They don't demand the goods as much as before. So in these situations, the excess supply is caused by the shift of demand curve. In the same in the same principle, there can be a situations for excess demand caused by the change of the supply conditions or the conditions of supply. Say there's a change in the technology or any other thing that changed the supply curve from S to another new curve I call S1. There's a change in the supply because of the conditions changed. As I said, maybe the production cost or technological advance. Then the new equilibrium price is no more at P. It shifts to this PS, I say, or P new S here. This PS, this new equilibrium based on the same demand or demand curve. In this situation, the supplier or the firms can produce more with even a lower price. Say here is QS. But if the market still keep at the same price as before, no change, then in these situations, there is still excess supply. So here we summarize in this chart, we have the surplus and the shortage, and we can explain why it comes out because of the price point for the consumers and the firms. They have different price point, then they have the excess supply or excess shortage. But when the change or the conditions of demand or the conditions of supply changed, then it affects the overall market situations. If they don't change the price, there will be possibility for excess supply or excess demand. And now we talk about some topics relevant to what we discussed on excess supply or excess demand. Here is the topic about minimum and maximum prices. In certain markets, governments may seek to ensure a minimum price for different goods and services. So there's maybe a political reason, or there is any other reason not considered as an economic reason. And to be effective, the minimum or the legal minimum prices must be above the current market price. So like the minimum wages, okay, some governments would like to set the minimum wages in the economy or for the labor markets to secure the so-called the basic income for those low-income persons in the society. And if the government sets the minimum price above the equilibrium price, there will be a surplus of supply created. So here is an example. We set a minimum price above the equilibrium price. As said, the demand for the goods is only at Q1 at the minimum price, but for the supply, it's at Q2 because of the higher price. The firms or anybody would like to deliver the goods or services at higher price with higher profit margin. And remember, we just showed in the charts showing that's the excess supply when the price or the manipulated price is higher than the equilibrium price. So in this case, we see the excess supply here. I just name it ES. Is the surplus or excess supply. On the other hand, governments may seek to impose maximum price or the price controls or price ceilings on certain goods or services. The purpose to have or to impose maximum price controls, first, to benefit consumers on low incomes. Okay, is the political reasons, so that the low incomes people or consumers can afford the particular good. Or second, to control inflation. So here is the government intention or the purposes why they have to impose maximum price. And if the government set the maximum price below the equilibrium price, or what we call price ceiling, there will be a shortage of supply created. In this chart, we show the maximum price set is lower than the equilibrium price. So you can see for the consumers, they demand at Q2 here. But for the suppliers or the firms, they are only willing to supply up to Q1. So there is a excess demand or shortage in the market. I name it ED, the excess demand. So at this price point, such as P2 in our previous chart, showing that the excess demand occurred because we see the consumers would demand up to Q2 given the price is lower and they can afford to pay for it, but the firms or suppliers, they are not willing to do so because the profit margin is so low for them to do it. We just mentioned about the price setting, like price ceiling or price floor. And now we examine what are the causes on those minimum or maximum prices. For minimum prices, it costs to have the excess supply. It costs misallocation of resources and the waste of resources. And for maximum price or maximum prices, it costs the shortages of supply because the supplier, they don't want to supply enough goods with such low profit margin, so they are willing to do so with the price level that they cannot increase. It caused the shortages of supply, and it derived the other problems like the people has to line up for the goods or to buy the goods. So it's about the arbitrary ways of allocating a product or resources. And last but not the least, here is misallocation of resources, because the people waiting to buy the goods, because of the price is very low, they wait to buy the goods. It means the waste of the resources, that is the time for those people. And if the time cost is very high for them, they don't want to line up for the goods, and they just pay a premium to others for lining up on buying the goods. Then it's a misallocation of resources, because finally the end user or end consumer of the goods has to pay the equilibrium price for it. Now we turn to another topic, but it's highly relevant to what we discussed about the maximum and minimum prices. It's the economic behavior of cost. The relationship between selling price and the quantity supplied or demanded also examines how costs tend to vary over time. What do we mean about over time? We have to divide the time horizon between the short run and long run. So for short term or short run, the short term cost behavior. In the short term, microeconomists believe that costs follow the law of diminishing returns. So what does that mean? The law of diminishing marginal returns is a theory in economics that predicts that after some optimal level of capacity is reached, that means we have a fixed factor or fixed factors. Adding an additional factor, in general, what we call is variable factor of production, such as labor, will actually result in smaller increases in output. So here is the definition of the law of diminishing marginal returns. In other words, this law indicates that in the short run, so what does it mean for the short run? Short run means there's a fixed factor, or so-called the optimal level of capacity. There's a fixed factor in the short run. You cannot change it. If you add more variable factor like labor, initially, maybe you can help to improve or increase the production volume. But at last, or finally, it will actually result in smaller increases in output. And here is an example showing the law of diminishing marginal returns. Initially, in the short run, we have the factory, we cannot change it, and we can add is the labor, the number of labor. We can add one more labor, two more labors, and so on. And if we add one labor into the factory line, the total product right now is 10 units. And the average is 10 because the 10 products divided by 1 is 10. And the marginal product change in total product is 10 as well because it comes from 0. 0 means nothing. And if we add 2 labor, so the second labor right now added into the production line, and the total product contributed by these 2 labors is 24. And the average product, that means the number of product divided by the number of labor is right now is 12. 24 divided by 2 is 12. And the marginal product, it means the incremental products contributed by the second labor is 14. Is the 24 total number of total product for 2 labors 24, and the only 1 labor is 10. So the difference between 2 labors and 1 labor is 14. So the second labor, it has the incremental volume increased by 14 units. And if we have 3 labors in total, so the total products right now achieve 36 units, and the average product is 12 because 36 divided by 3. And the marginal product for this incremental third labor, the incremental contribution by this particular labor is 12, is the difference between 36 and 24. So here you can see that the marginal product change for the third labor is 12. It is lower than the second labor. So if we move on to the fourth labor, fifth labor, sixth labor, the total product for this production line achieve the optimum at 48 at 5. Even we increase 1 more labor in the production line, the total production volume keep the same at 46. So you can see the marginal product change in total product is decreased from 14 to 12 and from 12 to 8 and then from 8 to 4. So even you increase the number of labor in the production line, the marginal product cannot be increased as much as at the initial stage. Here is the economic behavior of cost in the short run. When we put the numbers into a chart using a diagram or picture to show you how does it in visual presentation, then you can see the curve here, the short run average total cost curve, tends to therefore a U shape following the law of diminishing returns. That means the average cost initially can be decreased when you have more variables, say the labor, put into the production line, the total average cost can be decreased initially, but there's an optimum here. There's an optimum here, optimum point. So at this optimum point is the lowest average cost given the output at this level. Even after that, you can increase the output, but you have to be suffered by a higher average cost, because when you add more labor, such as labor or other variable factors, into the production line, it can increase a bit in the output, but the marginal product that an additional labor can contribute is less than before. So the total average cost will be increased gradually after this optimal point. This is the optimal point. We just explained about short term. The definition for short term here in economics, or the law of diminishing marginal returns, is we have fixed factor. And for long term, in general, in the long term, all costs tend to be variable in nature. This is because right now it's possible to vary the quantities of any factors that were fixed in the short term, like the production line, the capacity of the factory. You can change it in the long run. And one more topic under this long-term cost behavior, the terminology called this economies of scale. In general, the long-term cost behavior is different from the short-term cost behavior because there's no more fixed factor. So in the reality, the impact or the effect is sometimes from when the company is growing bigger and bigger, the effect is sometimes referred to as these economies of scale, because there's no more efficient or less efficient than before. And the final result is the average cost of production increasing. So finally, the long run average cost or long run average production cost is similar to the pattern what we show you in the short run. So after the discussion, I would like to do this in-class exercise with you, and just to have some ideas for you how to answer the question in a logical way. The government of country F has decided to impose a minimum wage for all workers, which is above the current average market labor rate. And which of the following is a potential consequence of this? Whether this change or this minimum price or minimum wage of all workers, what are the potential consequences? First, will it rise the employment within country F? Rising employment, or cost of manufacturing falls in country F? Or option C, leading to higher demands due to the lower selling price? Or D, there will be a labor surplus or surplus of labor created within country F. So remember when we show you a chart talking about the causes by government imposing the minimum and maximum prices. Here the case is the minimum wage. So let's look at the minimum prices. If you remember what we discussed, then you can answer this question.